Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn Associates, and I'm back. Had a 2-day illness, still not 100%, but believe me, I'm back. And today is Thursday, the 29th of November, 2018, just after 3:20 p.m. Central Standard Time. This is where the stock indices are going to finish the day off. So we have a very mixed picture. You don't need me to tell you that yesterday, Fed Chair Powell delivered the market a very nice boon by telling us the market, many of the members of the Fed had thought the market might be closer to the neutral rate, which he's not defining, than ever before. And that could mean lower amount of rate hikes that we see in 2019. We don't know. He said a lot of things yesterday to give the market, if you will, hope. However, that all gets dashed if the G20 this weekend doesn't go well. President is left for it. And now the question is, do we get a delay on tariffs? Do we get a reprieve on tariffs? Do we get no deal and the tariffs go into place? I'll let you figure that all out and the parlance that is going to come out of that meeting, because it is going to move these markets one way or the other. I still lean and can't get away from the fact that the president of both countries, China and the U.S., want to in some way get something done. And if they take a hard stance, they both have a lot to lose. That doesn't mean they're going to reach agreement on anything. But if they can open the door to get something done, what's the rush with the tariffs? That might be the thinking. On the other hand, if China's president shows nothing on the 4 big issues that I've written about, and you get them in my report, nothing will happen. So you have a mixed picture in stocks. You can see the dollar index up a little. Some of the currencies gave back something of what they made. Trying to figure out the British pound in front of the, I think it's the December 11th election. I'll let you figure that one out. Every day it's like going through a major report with that. In the energy market, we have an OPEC meeting coming up. I think it's December 6th, so keep your eye out for that. Russia, at least through their foreign minister and Mr. Putin, they're giving the idea that they're reluctant to make cuts, but they might be willing to, and that put a bid back into this market. So let's go and take a look first at the stock indices. What difference a couple of days make? This was last week, Friday the 23rd. The market was down 113.5 points for that week. We've made that up. We're up 114.5, and we're positive for the year right now. You do realize come Sunday you can take off, go through these highs. Maybe you get that strong year-end rally, and you can also come back through these lows on no deal and go into a funk into the rest of the year. When I take a look at where the market is, and let me go back here on the daily chart a couple of days. This was Monday. I got sick that night, wasn't in the office on Tuesday or Wednesday. I hope you don't get that flu, and I'm convinced that's what it was. Like, remember we used to get the 24-hour flu? Put me down. I would have looked for resistance if you rally back up to the 38% retracement level, up to, let's call it the 50% level. The market on Tuesday gets a rally. Then the Fed chair comes out and you get that spring, if you will, and you're up a little bit more today. I'm still going to say we're in this general area. I'm going to leave this high, this break low from the month of October is what the market is trading within right now. And I think the G20 will set the tone for what December is going to hold. When we take a look at swing lines, there is no trend. Now let me define trend. As a chartist, you rip the name off the chart. That's the first thing you should do. You should even remove scale. And what you should just be looking for is a pattern. In the pattern, if you're in an uptrend, you're making higher highs, higher lows. Downtrend, lower highs, lower lows. And in some sequence, you can make a lower low and a higher high, and then you have no trend. You have no trend as defined by that technique. When I take a look at moving averages, I look at this, and I'll come back here to when I was gone. This was Tuesday's action. If you continue rallying, the first resistance point would be the 18-day moving average of closes. It's from that number that I devise whether the market has downside bias or upside bias. If the market closes over it, it's upside, closes under it, it's downside. And when the market's down sharply, one of the areas it often tries to go to is the 18. When it's up sharply, it tries to retrace to that. Sounds simple. I teach it in great detail in my charting course, and it's very important to understand. So yesterday, the Fed chair comes out and certainly surprised the market. You get a monster rally, 58 points. Closing not too far from the day's high. You were at the high was 27.45, 41.5. It puts the 200-day average, if the market can continue to rally, as one of the next resistance spots, and this is what you did today. Let's not forget about our good friend, the algorithm called Bollinger Bands. What Bollinger Bands do is the market will trade within this algorithm 95% of the time. Via that, you come to the idea that the first time you hit a Bollinger Band, downside, upside, it doesn't matter. The first time you hit it, that's a potential, if you hit it on the down, a support zone, up a resistance zone. That does not mean it can't break out of that pattern. To break out of that pattern, often you need really tight sideways action. You do not have that here. I want to go right on record. That doesn't mean you won't go up and run away. I don't know what the president's going to do in the G20, and I think you realize anything can come out of this. The market can get a super bull reaction, a super bear reaction. There's just no way I know. The chart action is telling me, number one, I have no trend. Number two, I have upside bias, first resistance, and then I got a combination of resistance points, which I'm sure those of you that got caught in this market would love to see and feel better for the Christmas cheer, back to 28.19 to 28.25. When I look at momentum, the momentum is up, the bias is up, trend isn't up, and on this pattern, you cannot define a trend for tomorrow. If you take off, you're still going to have the lower and low, higher high. If you break down, you're still going to have the lower and low, higher high. You can't make a trend on that definition tomorrow. But I can say the bias and the momentum is up, supports back at the 18-day average, and the gold line is where you finish for the year. When we come to the NASDAQ came down, checked out last year's closing price, the gold line, came back, rallied to that 18-day average. Unlike the S&P, this is in an uptrend. You have higher lows, higher highs. Yes, there's a lot of risk because to break out of that, you got to come all the way back to this low, which is 64.95. But you are in an uptrend. You do have support at 68.42, and to break that, you got to take out the 64.95 level. The resistance on the upside, the 200-day average, you hear about that all the time on the different TV stations, financial TV, and the two areas of resistance here, 72.33 to 72.93. Obviously, the FANG stocks are what got hurt the most in the market, and it's interesting that this chart is showing the first uptrend. When I come to the Dow, it's like the S&P. I have the pattern of a lower low and a higher high. As you can see, for about a week or so, the market stayed under last year's settlement price. It has sprung back to life, but similar to the S&P, I have upside bias and upside momentum. However, I've got a resistance point at 25.06, which is the 100-day average. On the way down, I've got two support levels, the 200-day in the gray and the red, the 18-day average. The Russell is in the same family as the NASDAQ. It is in an uptrend. It's got higher lows, higher highs, and voila. The market comes up to the last year closing price. It stopped there yesterday. It stopped there today, but you're in an uptrend. So until you get under 1484.20, that trend is up. The bias is up. Everything's pointing to the upside. If you can clear this area, maybe 1587, the upper Bollinger Band can come into play. In the VIX, I want you to look at how often you're hitting this 18-day average of closes. That is a market looking for direction. It doesn't have one. It's got a lower low, higher high. It had been in a downside correction. That got knocked out. Believe it or not, it knocked that out of the market today. Not yesterday, today. And you took out that last high of 1993. So you've had no follow through to it. Lower bands or upper bands, just drifting in this market. Now in the T-bond market, obviously what the Fed chair said yesterday was friendly, and that gave a small lift by the end of the day to the marketplace. And today's the day you followed through. Now, you haven't gotten under this 18-day average of closes for most of this month. You can see that right through here. So it's kept an upside bias. At the same time, this market has an embedded slow stochastic. Let me define that for you. When both numbers that make up the slow stochastic reading are going sideways over 80, and you can see that they've been doing that, it means that pullbacks in the market often are getting bid up, and the resistance becomes the closest of a key moving average if one's above the market, which it is, the 100-day average, or the upper Bollinger Band. Now you can judge this on your own. If there's no deal with China, is that bullish or bearish interest rates? You know, no deal, tariffs are going up, inflation will go up because of that. It's a tax. The economies will get hit again. Do people run to the safety? If there is a deal, does that mean the tariffs aren't going up? The inflation doesn't go up from that? The economies might get better footing. It's not a deal. It might be a reprieve. It might be a delay. There's all kinds of words you can use there. This market's fighting that battle, in my opinion, right now. But the trend, up. As long as the embedded reading is there, pull off the name of the chart, pull off everything you know. That is, to me at least, the strongest reading you can get on a chart. So I look at this and I still say I am very much still in the bull camp, haven't changed my opinion, which means lower interest rates. When I go to TLT, I don't have that. I have a pattern of a lower low and a higher high with an overbought market. I have nothing on this particular one. In the dollar index, I was gone, as you know, on Tuesday and Wednesday. So when I had left, you have a market that is in an uptrend. I'm pretty sure I would have said that on my Monday evening tape. If the market continues higher, look for resistance, possibly at the upper Bollinger Band with support at the 18-day average of closes. The Fed chair speaks yesterday. You get up to 97.41, just missing the upper Bollinger Band, but you're knocking on the door. You're in the zone of resistance. Today you follow through, get literally right up to it. There is no 98. You round that down because the next number is a half cent, and bingo, and right back to the 18-day average of closes, and that's where you're at today. Yes, the trend is up. You've got downside momentum, though. You have upside bias. The trend, though, is up unless you take out 94.29.5. Now, which way do you think the president's, two of them, are going to go? What does it mean for the dollar? Some people think that the dollar goes down on a reprieve or a delay of tariffs. I've heard that. Other people think the dollar goes up if the tariffs go on because the U.S. is best suited to handle the full-blown trade war. Let you figure that one out. In the eurocurrency, you talk going back to neutral. Lower highs, lower lows, just missed the lower Bollinger Band yesterday after Fed Chair Powell spoke, went back to the 18-day average hanging there. This is a neutral market. You've got the bias up, the trend down, momentum pointing up. Don't know which way it wants to go. In the British pound, this is a mess. The chart is number one oversold, not quite embedded yet. You have a higher high, lower low. The bias is staying down, and every day you wake up, it's like going through a new report. Are more conservatives or Labour parties going to vote which way? Scotland said today they're not going with Miss May, but that doesn't change much. They were never in favor of having the Brexit, but it's just another part of opinion. As you move into the yen is still, in my opinion, in the bear camp. You have lower highs, lower lows. It's rallied back to the 18-day average of closes, which is the resistance point. To knock out the trend, you got to get over 88.90 from where the market finished. That's about 65 points away. It's a lot of money. It's still $700 roughly, so be a bit cautious, and momentum has gone flat. If the trend resumes, the lower Bollinger Band becomes a potential support. Resistance is right here, the 18-day average of closes. Bitcoin, it's time to get out of your November contracts. If you've been watching those, follow December. I think today or tomorrow is the last trading day. I don't know if it's tomorrow, but you don't want to be in the know. I will go by the momentum. An embedded slow stochastic, when and if it gets lost, often portends that price and the 18-day average are going to make a run at each other. Hasn't happened. Both numbers are staying under 20. Therefore, this is no more than a rally off of a break low of 3,500 and no more than that. Lose the embedded reading and I will join the camp at that point looking for a re-challenge of the 18-day average. Don't lose it. You might be going back down to that number. Doesn't mean I'm telling you what to do. It just means that's how I read the chart. In the Brent versus WTI crude, notice how the spread between the difference is coming in. So that is not a bullish factor. That's a bit bearish. When you go to the Brent crude, and you got to move away now from the Jan to the February, folks. By the way, this spread I've moved Feb to Feb, just so you can see the difference. I moved away from the Jan. But in the futures contracts, you want to trade the Feb Brent because it's the Jan's goodbye to it. Lower highs, lower lows. Lose the embedded reading. I will start thinking that a rally back to the 18-day average could be in the cards. Don't lose it. These rallies are still what to me? Bears still going to sell into them. January WTI crude is still the popular contract. It doesn't expire for quite a while. It has the embedded reading. Therefore, I think the bears are going to sell into this market, even with these rallies, and I think you watch that more than anything else. Where it gets interesting is gasoline. It's trying to point up. It has not come out of the embedded. Both numbers are still under 20. You have an outside day up. If you look at today's low at 135.41, it's the lowest of all these break lows. It's a key reversal day. What will reinstate the bearishness, it's already still bearish, is getting under today's low. Don't do that, and you've given hope to some people that a trade bottom is starting to form in the market, and you might get a price move ahead of momentum. It's often the other way around. In the natural gas, we still have the pattern of lower highs, lower lows. So the trend is down. The bias is up because you're over the 18-day average of closes. I want to be the first to say that when we had the embedded reading and you broke down, you did not make it to the 18-day average. Now if you make it, you just make it. The thrust should have been here right after that, and it held too well. So the market's giving a few stories that it still likes what it's doing, and it's consolidating all the gains that are put on from that breakout point. You know, we've put together our new futures trading kit. So this is the first time I'm telling you about it. Let me finish up as we do this. And I realize it's a long tape, but I wanted to make up for 2 days of you missing it. These are the different chapters. And believe me, we have added to everything that we've got here. Be it options. Exchange brochures just aren't brochures. There are courses from the exchange, quizzes from the exchange. You're going to get the history of how this all began. When I talk chart patterns, these are all new, redone, to help you better understand the common chart patterns out there. We give you the brochures, guides 1 and 2 to technical analysis, as we've done in the past. Then you're getting all these different chapters that come in as you keep looking at things. Options, a lot on options. Cause and effect, that deals with what the Fed does, how it impacts the futures markets one way or the other, how to look at things. You know that we have a 3-part pivot point series. Now we're adding a rune to it. So you're going to get that in this as well. As we keep going with this, you can see that lessons from the CME group's educational brochures. So here are the different modules that you get. We point you to them. You're on their site. You learn the different areas. We're making things easy for you to learn. Then how do you buy? How do you sell? Why would you come to those conclusions? That is the idea behind this. So if you'd like this complete kit, and it's a link, that's what we give you, and bang, it just opens up for you and away you go. Call us, go to our website. We'll email it to you right away or click up here. I'm Ira Epstein. Sorry for being so long today, but there was so much to say. You have a good day.